So the home goods industry right now is basically shrinking. I mean, housing mobility is just frozen tight.
Yeah, completely frozen.
Right. We're living in this reality where high mortgage rates mean people simply aren't moving.
Yeah.
And, the conventional wisdom, like the absolute ironclad rule of retail, is that if you aren't buying a new house, you aren't buying a new dining room table to put inside it.
Exactly. You just make do with what you have.
Yeah. But somehow, against literally all of those macroeconomic headwinds, Williams-Sonoma just posted this massive acceleration in growth and compounding margins.
It's a complete anomaly. I mean, you look at the broader sector, and management even noted on their call that the industry was down, in the low single digits for the quarter, but their numbers are going in the exact opposite direction.
Which is exactly why we are doing a special Talk Tickers edition of our deep dive today. We're unpacking the Williams-Sonoma Q1 2026 earnings call transcript to figure out how they are, defying the laws of retail physics.
It really feels like that, doesn't it?
It does. So our mission today is to take all that corporate jargon, all those dense financial metrics, and translate them into something you, the listener, can actually use. We're going to be data forward, we're going to speak in plain English, and we're going to extract the absolute most vital nuggets of insight for anyone looking at this stock.
Right, because if we look closely at this transcript, we aren't just looking at a company that sells like nice couches and high-end spatulas.
Yeah, definitely not.
We're looking at an operating model that has basically been engineered to act as a fortress against external shocks.
Yeah.
It's a study in how to manipulate the levers of a business when the outside world refuses to cooperate.
Okay, let's unpack this. Let's start with the hard data because, to understand the strategy, we have to see the scoreboard first.
Absolutely. Show me the numbers.
So the top line numbers are frankly staggering. Net revenues hit $1.81 billion. Their comparable brand growth, which Wall Street usually just calls comps, came in at a positive 4.8%. And their earnings per share, or EPS, was $1.93. That's up 4% from last year.
Those numbers alone, in a contracting market, represent a massive beat against expectations.
Yeah.
And what stands out even more is that both their 1-year and 2-year comps actually accelerated from the fourth quarter of last year right into the first quarter of this year. So the momentum isn't just holding steady, it's actively building.
But okay, the number that really made me do a double take is the operating margin. They delivered an operating margin of 16.2%.
Yeah, that's the big one.
Wait, hold on though. Let me push back on this a little because we know that shipping costs, ocean freight, and all these geopolitical tariffs are eating everyone else in the sector alive right now.
Oh, totally. It's a bloodbath out there for margins.
Right. You can't just find that kind of margin expansion hiding in the couch cushions. So how on earth did they expand the bottom line in this environment? Are they just, getting lucky with freight rates?
No, not at all. What's fascinating here is the underlying mechanics of how they actually pulled that off, because they definitely took some hits. If you look at their gross margin, it actually did dip slightly to 44%.
Okay.
That's down about 30 basis points compared to last year.
Let's translate basis points for a second. For anyone listening who isn't staring at a Bloomberg terminal, what does that actually mean?
Sure. A basis point is just 1/100th of a percentage point.
Got it.
So when we say down 30 basis points, we basically mean their gross margin dropped by 3%. It's a really small dip, but the interesting part is why it dipped.
Why did it?
Well, their chief financial officer, Jeff Howie, detailed that their merchandise margins specifically dropped by 100 basis points. So that's a full 1% hit to their profitability.
Wow.
And he was very clear about the cause. It was higher tariffs flowing through to their weighted average cost of goods sold. That 1% drop is the pure, unfiltered impact of geopolitical trade policy hitting their balance sheet.
Okay, wait. So they took a full 1% hit from tariffs, but their overall margin only dropped by 0.3%.
Exactly.
That means they had to find a bailout somewhere else in the business.
Yeah, they essentially engineered their own bailout using internal efficiencies. The CFO noted that they pulled 50 basis points of gross margin benefit directly from their supply chain.
Oh, wow.
And a significant chunk of that came from a lower shrink accrual.
Okay, shrink. We hear shrink all the time in retail news right now, usually accompanied by security footage of people walking out of drugstores with armfuls of merchandise. It basically means theft or lost inventory, right?
Yes, exactly. But shrink accrual is the accounting side of that reality.
How so?
It's essentially the pool of money a company sets aside on their books, defensively assuming a certain amount of inventory is going to be lost, damaged, or stolen over the year.
Ah, I see.
Because Williams-Sonoma's actual physical inventory counts came in better than they had defensively planned for in the previous year, they were able to lower that accrual rate.
Okay, so they didn't lose as much product as they feared, so they basically get to reclaim that margin on paper.
Precisely. They clawed back that margin.
And what about the rest of the offset? Because if they saved 50 basis points on supply chain and shrink, where did the other 20 come from to mitigate that 100 basis point tariff punch?
Right. The math has to balance. The remaining 20 basis points came from occupancy leverage. And this is a crucial retail concept.
Break that down for us.
So occupancy costs are your fixed real estate expenses. Rent for the stores, facility costs, basic upkeep. During this quarter, their actual occupancy dollars increased by 3%. Their rent went up.
Okay.
But because their top-line revenue grew so strongly, remember that 4.8% comp growth we talked about, the sales grew significantly faster than the rent did.
I get it. So if your rent goes up a little, but your sales go up a lot, your rent just naturally becomes a smaller percentage of your total revenue.
Exactly the concept. That is occupancy leverage in a nutshell. When you combine that leverage with the supply chain efficiencies, that massive 1% tariff hit is smoothed out into a tiny 0.3% dip in overall gross margin.
I mean, what's really wild to me is that they achieved this revenue growth without slashing their prices.
Yeah. That's the kicker.
Because usually when a retailer feels the pinch and needs to drive top-line growth to cover rising costs, they hit the panic button. They throw like a 40% off sale on everything in the store.
Totally. A race to the bottom.
Right. But the CFO explicitly stated that their full price selling remained flat year over year. They're still getting people to pay top dollar.
Which forces us to ask, in a highly inflationary environment, how are they convincing consumers to pay full price for premium furniture?
Well, math doesn't buy couches. People do. So we need to look at the portfolio effect.
Yeah.
Williams-Sonoma isn't just one monolithic brand.
Far from it.
Right. It's a strategically stacked portfolio. Let's look at the brand by brand breakdown because every single brand posted positive growth, which is crazy.
It really is.
West Elm was the absolute superstar at 8.5% comp growth. The namesake Williams-Sonoma brand was up 5%.
Yep.
Pottery Barn Kids, which encompasses their teen and nursery lines, was up 4.5%. And even the flagship Pottery Barn brand, which had been pretty sluggish recently, clawed its way back to a positive 1% comp.
And this multi-brand strategy, it's the ultimate hedge against consumer volatility. You are essentially capturing the consumer at multiple distinct life stages and aesthetic preferences.
Walk us through that life cycle.
Think about it like this. You have the young professional outfitting their first real apartment, right? They go to West Elm. Then maybe a few years later, you have a couple upgrading their kitchen for entertaining, and they head to Williams-Sonoma for the high-end cookware.
Makes sense.
When they start a family, they're outfitting nurseries with Pottery Barn Kids. And as established homeowners, they transition to the classic aesthetics of Pottery Barn.
So even if the housing market is totally frozen, meaning that family isn't buying a new 4-bedroom house to fill entirely with new Pottery Barn furniture, they are still spending money.
Exactly. They stay put.
They stay put, and maybe they upgrade the kitchen appliances at Williams-Sonoma, or they redo their teenager's bedroom. The discretionary spending doesn't evaporate. It just shifts to a different aesthetic under the exact same corporate umbrella.
That is precisely how they're stealing market share. While the rest of the industry is shrinking because they only serve one specific need or one specific price point, Williams-Sonoma is capturing the dollars that are still in motion across the entire demographic spectrum.
Let's dig a little deeper into that West Elm number, though, because an 8.5% jump is huge.
It's massive.
It reminds me of a classic rock band that suddenly finds a brand new generation of teenagers streaming their music on TikTok or something. The CEO, Laura Albers, said West Elm is on a roll, and the results are compounding.
And she specifically attributed a lot of that momentum to their collaboration with Emma Chamberlain.
Okay, for listeners who might not track the influencer space, Emma Chamberlain is a cultural juggernaut for Gen Z and younger millennials. Yeah. She's a massive tastemaker. But I have to push back here a little bit.
Go for it.
A lot of heritage brands try to partner with young influencers, and it usually ends up looking forced, or it creates this brief spike in likes on Instagram that never actually translates into compounding sales. Why did this one actually work?
Because they didn't just pay her to hold up a pillow in a post. They co-created a distinctive product line that injected a completely new energy into the brand.
Okay, so it was authentic to her style.
Exactly. Albert described it as bringing back that hip feeling and that surprise. Heritage brands often struggle with younger demographics because their legacy feels, heavy or outdated to a 20-something.
Right.
The Chamberlain collaboration acted as a bridge, pulling a massive younger audience right into the top of the sales funnel.
But a top-of-funnel hype spike doesn't explain sustained 8.5% growth. I mean, you have to actually close the sale.
And that is where their operational execution comes in. Management highlighted that they had significantly better in-stock availability in their stores.
Oh, that's huge.
Yeah, when these younger consumers walked into a physical West Elm store to see the Chamberlain collection, the products were actually there to buy. They paired cultural heat at the top of the funnel with flawless inventory management at the bottom.
That's a rare combo.
It really is. Furthermore, both their spring and summer product launches hit the mark across furniture and non-furniture categories. They drove this growth entirely on brand desire, not by relying on promotional clearance racks to move dead inventory.
I mean, that is the anatomy of a successful retail turnaround right there. But as flashy as the West Elm story is, I want to pivot to the hidden engine of this company. The numbers that genuinely blew my mind were in their business-to-business or B2B division.
Oh yeah, the B2B numbers are wild.
They grew this segment by 13.7% overall. That marks a record-breaking quarter for them.
For retail investors, it is incredibly important to understand that Williams-Sonoma is no longer just a direct-to-consumer business.
Right.
This B2B division is a massive structural pillar of their revenue now. It's broken down into two main channels, trade and contract.
Okay, break those down.
The trade side, which involves interior designers and local professionals buying for their clients, that grew by 9%.
Solid.
But the contract side is where the real explosion is happening. That grew by an astonishing 22%.
Yeah, we need to define contract because it changes the entire scale of how we view this stock. We aren't talking about, a designer buying 2 armchairs for a client's living room. We're talking about massive commercial infrastructure.
Huge projects.
Right? The CEO named some of the marquee projects they delivered this quarter. Yeah. The Delano Hotel in Miami, Live Nation entertainment venues in Philadelphia, and the Capital One Arena. They're even supplying upcoming work for the U.S. Open tennis tournament.
The cash flow implications of those projects are entirely different from consumer retail.
How so?
Well, when a developer is building a luxury high-rise or outfitting an arena VIP lounge, they aren't logging onto a website and waiting to see if consumer confidence drops next month before clicking buy.
Right. They're locked in.
Exactly. These are multi-million-dollar budgets with strict timelines. They need reliable, massive scale fulfillment.
And it provides incredibly sticky revenue. If you're outfitting 300 rooms in a Miami resort, you need the furniture to arrive exactly on schedule, uniformly built, and ready to install.
You can't have delays.
No. And Williams-Sonoma is leveraging its massive global supply chain to offer these designed-to-deliver capabilities that mom-and-pop commercial furnitures simply cannot match. It diversifies them away from the fickle, sentiment-driven retail shopper.
Which is exactly why that 22% growth is so vital. It acts as a counterbalance. If the housing market remains stagnant and the everyday consumer pulls back, these massive commercial contracts keep the revenue flowing and the supply chain humming at scale.
Let's shift gears to a topic that always triggers my skepticism radar. AI, artificial intelligence.
Ah, yes. The buzzword of the year.
Seriously. Every single CEO right now is dropping the acronym AI into their earnings calls. Half the time, it feels like a cheap trick just to pop the stock price for the algorithm trading bots listening in.
Yeah, it's a valid concern.
So is Williams-Sonoma actually utilizing this technology in a way that generates real revenue? Or is it just corporate fluff to sound modern?
It is a totally valid concern, but the evidence presented in the transcript pushes this far beyond corporate buzzwords.
Okay, convince me.
They aren't talking about abstract theories. They are detailing tools that are actively integrated into their daily operations. Let's look at 3 specific areas. First, their room planner tool. They're using generative AI to help customers visualize room plans with photorealistic images.
Visualizing furniture is a huge psychological barrier.
Massive.
If I'm going to drop $3,000 on a sectional sofa, my biggest fear isn't the checkout process. It's the fear of making a massive mistake. I'm terrified the velvet fabric is going to clash with my rug or that the dimensions will literally swallow my living room.
And that fear creates friction, which leads to abandoned online shopping carts.
Yep.
By providing a photorealistic, personalized visualization, the AI drastically lowers the psychological risk of the purchase.
Okay, what's the second area?
Secondly, they built an AI studio that is generating lifestyle imagery at an unprecedented scale.
What does that mean exactly?
They're taking data signals from a customer's browsing habits and creating a customized, complete look rather than just recommending a single, isolated product.
Oh, wow. So instead of just, you might like this lamp, it's showing the lamp in a room designed for your taste.
Exactly. But the element that truly convinced me they aren't just blowing smoke is the customer service bots.
See, I usually hate interacting with those automated chatbots. They're incredibly frustrating.
Historically, yes, they've been terrible, but management noted that their AI bots are handling highly complex questions about cooking and entertaining, and here is the vital metric. The AI bot is actively converting browsers into buyers.
Wait, really?
Yes. It sits on the product pages, answers real-time questions, and drives customers to the checkout page at a significantly higher multiple than their standard website traffic.
I mean, if an AI bot is converting at a higher rate than a customer browsing on their own, that is a verifiable, measurable sales engine.
Absolutely.
It's acting like a digital interior designer on the floor of a showroom, answering those final lingering questions that prevent someone from pulling the trigger.
It's also being utilized on the back end, too. They mentioned using AI within their supply chain to identify efficiencies in transportation and delivery life cycles.
And that connects directly to what might be their biggest operational advantage, logistics and the last mile.
Yes. Let's talk about the last mile because they dropped a number on the call that is just hard to wrap your head around.
Lay it on me.
They do 2.4 million in-home deliveries a year.
Wow.
That works out to roughly 7,000 deliveries every single day.
It is a logistical empire. And the CFO heavily emphasized that they manage this process better than almost anyone else in the industry. They are intensely focused on controlling the white glove service experience.
Right. And white glove, meaning it's not just a box dropped on your front porch in the rain by some third-party delivery service.
Correct. They bring it inside, they assemble it, they place it in the exact room, and they remove all the packaging. Their internal success metric is what they call the perfect order.
The perfect order. I like that.
Yeah. Was it delivered on time? Is it completely damage-free? Is it exactly where the customer wants it? And most importantly, is the customer satisfied with the final result?
I read that they actually require the customer to sign off acknowledging their satisfaction, and the delivery teams take photographs of the completed installation in the home.
That level of operational paranoia is intense. But why does it matter so much to the stock price?
Because returns are the silent killer of furniture retail.
Oh, totally.
Think about the anatomy of a return for a heavy, bulky item, like a solid wood dining table. It is catastrophic for margins. First, you lose the initial sale.
Yep.
Then you have to pay a team to go back to the house, retrieve the heavy item, and transport it back to a warehouse. You're taking a massive hit on the cost of the damaged or unwanted inventory. And finally, you have likely lost the trust of that customer forever.
It's just a compounding loss.
Exactly. By prioritizing the flawless white glove last mile delivery, Williams-Sonoma keeps their return rates remarkably low.
It's a massive margin protector. They understand that supply chain efficiency isn't just about moving boxes quickly from point A to point B. It's about guaranteeing that the box never ever has to come back to point A.
Well said. Now, before we move into their future guidance, we should probably briefly touch on the leadership and emerging brand momentum they highlighted.
Good point.
The flagship Williams-Sonoma brand is celebrating its 70th anniversary this year.
And a 7-year-old brand can easily become stale. But they are keeping it relevant with incredibly smart culinary and design partnerships. Yeah, they really are. They mentioned launching a specialized Stanley pizza oven. They are doing a food collaboration with the historic Oakville Grocery in Napa Valley. And they brought on Kelly Wearstler, who is an absolute icon in interior design, as a spokesperson.
They're guarding their premium status by strictly associating with premium cultural touchpoints.
Exactly. We also saw a significant leadership transition announced at Pottery Barn. Monica Bargava, the former president, is departing after 26 years with the company.
Right. And Jennifer Keller, who is a 29-year veteran of the organization, is stepping into the president role.
Now, a leadership change at a flagship brand is always something investors need to monitor closely. But the fact that they are promoting a 29-year veteran internally suggests they're prioritizing stability and institutional knowledge rather than, a radical strategic pivot.
Yeah, it's a safe pair of hands. But what is arguably more exciting for the long-term growth story are their smaller emerging brands.
Oh, for sure.
Rejuvenation and Mark & Graham both posted double-digit positive comp growth this quarter. Rejuvenation is highly focused on project-led categories. Think premium cabinet hardware, lighting fixtures, and bathroom remodels. Mark & Graham is their personalized gifting hub.
They are smaller pieces of the pie right now, but they are highly profitable and scaling rapidly. The CEO went on record stating she believes Rejuvenation has the potential to become their next billion-dollar brand.
That's a bold claim.
It is. When a management team that already oversees multiple billion-dollar brands makes a projection like that about an internal incubation, investors really need to pay attention.
It proves they aren't just relying on their legacy names. They are actively cultivating the next generation of revenue streams.
Okay, so let's summarize the story so far.
Let's do it.
They crushed the first quarter. They have incredible momentum across West Elm. Their B2B contracts are exploding. Their emerging brands are seeing double-digit growth. And their margins are being fiercely protected by elite supply chain logistics.
Yep.
Naturally, with all of these massive wins under their belt, they must have dramatically raised their financial guidance for the rest of the year, right?
No, they didn't.
And this brings us to what I am calling the cautious beat.
I like that term.
Thanks. This is where we shift to the future, looking at what management said about the rest of fiscal 26 and why they are playing their hands so incredibly close to the vest. They simply reiterated their previous guidance. They refused to raise it.
Yeah.
They still expect revenue growth to land between 2% and 6% with a midpoint of 4%. And they expect operating margins to stay flat in that 17.5% to 18.1% range.
This is exactly the kind of move that makes Wall Street very jittery.
Why is that?
Well, when a company posts a massive beat on both the top and bottom line in Q1, but management refuses to raise the outlook for the full year, the immediate assumption by analysts is that trouble is brewing in the later quarters.
It demands an explanation.
Yeah.
I mean, if you run a marathon and completely shatter your expected time in the first 5 miles, the math dictates that your overall finishing time should improve. Unless, of course, there is a massive mountain you have to climb in mile 10. So the question is, are they just sandbagging so they could look like heroes when they beat expectations again later this year? Or is there a monster hiding under the bed that they aren't fully explaining?
If you listen closely to the CEO's justification, she is essentially modeling for severe macroeconomic pessimism.
Okay.
She explicitly told analysts that they are assuming no material housing recovery this year. They're building their internal models on the assumption that geopolitical volatility, wars, high fuel prices, and punitive interest rates are going to persist.
They are preparing for an incredibly hostile external environment.
Exactly. So it's not necessarily that they're seeing internal weakness or a drop in consumer demand for their specific products. They are simply refusing to bet that the outside world is going to get any easier to navigate.
It is a posture of maximum conservatism. But there is one very specific, mathematically tangible cloud on the horizon that the CFO detailed extensively. And it all comes back to the tariff situation.
Yes. We need to unpack this tariff cloud because this isn't just abstract political posturing on a news network. This is hard accounting that directly impacts profitability.
Right.
The CFO revealed that they currently have $60 million of embedded incremental tariff costs sitting in their inventory right now.
This is a critical accounting mechanism for any retail investor to understand. When tariffs go up, the cost of importing a shipping container of furniture rises.
Yep.
But those higher costs don't hit the company's income statement on the day the container arrives at the port. Instead, those goods sit on the balance sheet classified as inventory.
Think of their inventory pipeline like a python that just swallowed a pig.
That's quite the visual.
Right. That $60 million in higher tariff costs is the pig. It is sitting right in the middle of their warehouses. As they sell that specific inventory to customers over the next few quarters, that lump has to pass through their income statement.
Ouch.
And as it moves through, it is going to put intense, unavoidable pressure on their margins.
That is a perfect way to visualize it. And management expects this tariff impact to be what they call front half weighted.
Let's translate front half weighted for the listener.
It means the financial pain is going to hit hardest in the first 2 quarters of their fiscal year. The CFO noted that Q2 will likely see the absolute peak of this margin compression as that expensive inventory works its way through the system.
Right.
By the time they reach the back half of the year, Q3 and Q4, which includes the vital holiday shopping season, that lump should have passed and the tariff pressures should moderate.
But there is a twist here that highlights just how conservative their guidance really is.
What's the twist?
The CFO mentioned the possibility that they could receive tariff refunds.
Oh. How are they factoring that potential windfall into their numbers?
They aren't.
Wait, really?
Really? They are zeroing out any potential upside from refunds in their guidance. They are building their public models on the assumption that they will get absolutely nothing back from the government.
And what about the expiration dates? Because he also mentioned that certain Section 122 tariffs are said to expire in July.
Again, they applied maximum conservatism. Their guidance assumes that those expiring tariffs will simply be replaced by new tariffs at an identical rate.
Wow, they are modeling for the absolute worst-case scenario regarding trade policy.
Yes.
So if the political climate improves, if tariffs are dropped, or if they successfully win those refunds, every single dollar of that becomes pure upside to their current guidance.
It definitely sounds like sandbagging, but frankly, given the volatility of global trade right now, it's entirely justified sandbagging.
I agree. Now, if you want to know what a management team really believes about the health of their company, you don't listen to their forward guidance. You follow the money.
Yes.
Let's talk about capital allocation.
This is where the story gets incredibly bullish. In Q1, Williams-Sonoma spent $58 million on capital expenditures, or CapEx.
And CapEx is just the money a company reinvests into its own physical infrastructure to maintain or grow the business.
Right.
They noted that 95% of that $58 million went directly into e-commerce technology, retail store updates, and supply chain improvements.
But look at what they did with the rest of their cash. In that exact same quarter, they returned a staggering $373 million to their shareholders.
Let that ratio sink in for a second. They invested $58 million into the business, and they handed $373 million back to the owners of the stock. How did that break down?
They spent $288 million on stock buybacks. By doing that, they retired approximately 1.4% of their total outstanding shares in a single 3-month period.
That's a huge chunk.
It is. On top of that, they paid out another $85 million in dividends.
And they still have $1.1 billion formally authorized for future share repurchases. Furthermore, the CFO proudly pointed out that this quarter marks their 17th consecutive year of increasing their dividend payout.
When a management team is aggressively buying back their own stock while maintaining a nearly 2-decade streak of dividend increases, it sends a crystal clear signal to the market. They fundamentally believe their stock is undervalued, and more importantly, they have supreme confidence in their free cash flow.
Right.
Their ability to generate hard cash from their operations, regardless of how hostile the macroeconomic headwinds become. Management refers to it as having a fortress balance sheet, and that aggressive level of cash distribution absolutely validates the claim.
It's the ultimate proof of conviction. You do not authorize $1 billion in buybacks and commit to a growing dividend if you secretly think your underlying business model is cracking under the pressure of a frozen housing market.
No, definitely not.
You only do that if you know your foundation is rock solid.
Which brings us to the final analysis.
Exactly. We have parsed the headline numbers, we've explored the operational story behind them, and we've translated management's highly cautious guidance. Now, it is time for the bottom line.
The moment of truth.
What does this all mean for the retail investor listening right now? Let's lay out the bull case and the bear case. I want the strongest arguments for both sides. Let's start with the bull case. What are the strongest buy signals here?
The most compelling argument for the bull case is undeniable market share acquisition. The overall home furnishing pie is shrinking, but Williams-Sonoma's specific slice of that pie is getting significantly larger. They are proving they can grow even when the industry as a whole is contracting.
And crucially, they are doing it while maintaining incredible pricing power. In a retail environment where consumers have been deeply trained to wait for massive holiday discount events, the fact that their full price selling remained completely flat year over year is a monumental sign of brand strength.
Absolutely.
They aren't in a race to the bottom on price.
Adding to that bullish narrative is the mechanics of their omni-channel model.
Right.
The CFO described their strategy as digital first, but not digital only. They've built the digital infrastructure to capture massive online sales, aided by those high-converting AI bots we discussed earlier. But they utilize their physical retail footprint strategically. The stores act as design centers, brand touchpoints, and showrooms that funnel the customer right back into the digital ecosystem. It is highly optimized.
And of course, the sheer volume of capital being returned to shareholders provides a massive concrete floor for the stock price.
Oh, yeah.
If the broader market dips, management is standing there with a $1.1 billion war chest ready to buy up their own shares at a discount. That creates a very comforting safety net for an investor holding the stock.
It does.
But no company is invincible.
Let's look at the bear case. Where does this fortress crack? What are the risks investors need to monitor?
The primary risk, as we analyzed with the python and the pig metaphor, is the assumption that tariff pressures will naturally moderate in the back half of the year.
Right.
Management is modeling for a peak of margin compression in Q2, followed by relief. But if global trade tensions escalate further, or if those expiring Section 122 tariffs are replaced with significantly harsher penalties rather than equal ones, the math changes completely. And there is a limit to how much they can offset those costs internally. You can only optimize a supply chain so much. You can only reduce your shrink accrual so far before there is simply no more fat left to trim.
Exactly.
If geopolitical costs continue to skyrocket, eventually they will have to pass those costs on to the consumer, which could finally break that full price selling streak.
The other major pillar of the bear case is their reliance on the broader housing market. Right now, they are successfully executing a strategy of convincing people who are staying put to upgrade their current living spaces.
Remodelers.
Right. But if mortgage rates stay near 8% and the housing market remains completely frozen for the next 3 to 5 years, eventually that well of upgrade revenue is going to run dry. There are only so many times a consumer will refresh their kitchen hardware.
Sure.
Williams-Sonoma is fighting an uphill battle because they are missing out on the massive structural spending spikes that historically accompany new home purchases.
So bringing it all together into an actionable takeaway, I am speaking directly to you, the listener, right now. Whether you are currently holding WSM in your portfolio or you are evaluating a potential entry point, what you are looking at is a masterclass in management executing through an absolute storm.
A masterclass.
This is not some speculative, high-flying tech stock banking on product that doesn't exist yet. This is a highly defensive consumer discretionary play backed by aggressive, consistent shareholder returns. You hold this stock because you trust this specific management team to extract margin out of an incredibly difficult environment, all while paying you a steadily growing dividend to wait out the macro turbulence.
They have proven they do not require a booming, euphoric economy to compound their growth. They've built an all-weather vessel that can navigate the current reality.
And as we wrap up this deep dive, we want to leave you with one final thought to mull over. We started this conversation by talking about how Williams-Sonoma is defying the gravity of a frozen housing market.
Right. Think about the alternative scenario. Right now, Williams-Sonoma is compounding their top-line growth, expanding their operating margins, and generating record amounts of B2B cash flow in an environment plagued by zero housing mobility, high inflation, and punitive global tariffs.
Yeah.
This raises an incredibly important question. What exactly happens to their operating leverage when the macroeconomic environment actually improves? When interest rates finally drop and the housing market unfreezes?
If they're running this fast uphill, with the wind aggressively in their face, what happens to this business model when the wind is finally at their back? That is the billion-dollar question for anyone watching this space. Thank you for joining us on this special Talk Tickers deep dive. Keep looking beyond the headline numbers, demand to understand the mechanics behind the metrics, and we will see you next time.